All right, now's a great time to review the stocks in your 401k or other retirement plans. Financial planner Karen Lee joins us next. So it is the #1 issue in American homes, getting your financial house in order. Today in our weekly financial fix, making money in the stock market. Let's bring in the author of It's Just Money, So Why Does It Cause So Many Problems? Karen Lee. All right, so Karen, last week we talked about building your financial house and having a strong foundation.
Right.
So when people talk about, and retirement planning was part of that too.
Yes.
People think about retirement planning, they're thinking about their 401ks and those long-term investments that come by way of stocks and investments.
Right.
So how do you assess?
Well, and the reason I really wanted to talk about this today is because the last decade's been pretty rough in the market. And a lot of people are turned off and saying, I just can't make money in the stock market. So this was about, can the average Joe investor make money in the market? And the answer is yes. Absolutely.
Because people are nervous.
People are nervous, but there are some tried and true strategies we're going to talk about today. It's a strategy called asset allocation. It's based on modern portfolio theory, which was a Nobel Prize winning strategist in 1990. So absolutely you can make money. Let's talk about how to do this.
How do you do that?
Okay. The first thing we're going to talk about is, let's talk about the 401k, or say if you had a 529, or even a non-retirement investment. If you're picking which investments to get into, so the first thing you need to do is evaluate your tolerance for risk. Now, recognize that there are different types of assets. There's cash.
High risk, low risk.
Right. And that you've got cash and bonds, and then stocks. Cash and bonds are more conservative, stocks are more aggressive, but within each of those segments, there are subsets. So with stocks, we've got U.S. and international, large company, small company, medium-sized companies. And so once you've determined what percentage, stocks versus bond, then make sure you spread it amongst all those different asset classes and make sure you include some real estate and perhaps some commodities. So now you've got your percentages and which funds are going to be in, right?
Yeah, so you're diversifying in this way, as it pertains to diversifying all of your investments.
That's correct. Now, there was a time when I remember that one of the strategies was just invest in the S&P 500. Yeah. That does not work. It just turned out that in the decade when that was said, it would have been enough. In this last decade, that wouldn't have worked. It would have come out zero. So you want to spread amongst these different investment classes. And then the second thing you want to do is you want to rebalance them, at least annually.
So you don't want to feel so comfortable with the selections that you've made. Let it go.
No.
Don't even, check and just hope for the best. You do want to go back.
A minimum
and
of once a year. Reallocate. And you know what it does when you go back to the original percentages? It forces you to sell off some of the winners, sell high, and buy back into some of the asset classes that weren't doing so well. Buy low. So that's what we're supposed to do, right? Buy low, sell high, buy low, sell high. So don't sit back and do nothing.
Okay. And then you want to, and you say you really want to keep investing.
One of the biggest mistakes investors make, the minute the market starts to go down, they either stop or they start steering their current contributions into the money market or the stable value fund. Big mistake, because think of it this way. As that market's going down and you're methodically buying in, you're buying those asset classes on sale. Yeah. When it turns around, which it inevitably does, what goes down is going to come up. That's going to make like a rocket ship your gains by buying in.
And that's when you're underscoring, you get through it all, you have to remain patient.
Right. So that was my final thing is I see people that just every 3 years jump out.
Yeah.
10, 20-year time horizons are what I want these investors to be looking at.
Excellent.
And don't make a short-term jump.
All right, Karen Lee, always good to see you. Thanks so much for making us smarter. And you can get more information by reading Karen's new book, It's Just Money, So Why Does It Cause So Many Problems? Or reach Karen at KarenLeeAndAssociates.com. And later on CNN, if you want to go back to school or just get a jump start on your career, perhaps, we'll have